Feel like investing's become a full-time job? Between AI stocks, covered call ETFs, REITs, dividend growers, and even meme coins named after Elon's dog. It's chaos out there. But what if you could forget all that noise and just own one ETF forever? No rebalancing, no stress, just one lazy fund, quietly growing your money to $3.2 million, while you binge Netflix and ignore CNBC. Today, we're diving into the ultimate lazy investing strategy. We'll break down 3 heavyweight ETF categories: broad market, dividends, and growth. And by the end, you'll know the one ETF worth holding forever. No guesswork, no rebalancing, just one fund that could quietly turn $100,000 into over $3.2 million while you live your life on autopilot. Before we dive headfirst into ETF land, we need to lay down some ground rules because, let's be honest, there are thousands of ETFs out there, and not all of them are created equal. Some build wealth, others just shiny wrappers around the financial quicksand. So how do we separate the forever ETFs from the fast flops? It starts with rule number 1, diversification. A true forever ETF spreads your money across hundreds, sometimes thousands of companies, different industries, different sectors, maybe even different countries. Why? Because when one part of the market zigs, another zags, and the last thing you want is your entire portfolio tanking just because energy stocks slipped or tech took a hit. But diversification alone doesn't cut it. Rule number 2, a battle-tested track record. We want at least 10 years of performance through the bull runs, bear markets, and full-blown crashes. Anyone can look good in a hype cycle, but we're after consistency, stability. An ETF that held firm during the dot-com bust, the 2008 meltdown, and bounced back after the COVID crash. That kind of history, it's like a financial scar badge. It shows resilience. And finally, rule number 3, ultra-low fees. Fees are the silent killer. You won't notice them day to day, but over decades, they eat your gains alive. That's why we're only looking at ETFs with rock-bottom expense ratios, fractions of a percent, because every dollar lost to fees is a dollar not compounding in your favor. So here's the deal. If an ETF isn't diversified, battle-tested, and dirt cheap on fees, it's not forever material. Now that we've set the bar, let's meet the contenders. Broad market ETFs. If you're only going to hold one ETF forever, it makes sense to pick something that gives you front row access to, well, everything. Broad market ETFs are like the ultimate sampler platter. You're not betting on Apple or Amazon. You're investing in the entire economy. When one stock stumbles, another steps up. Diversification is baked right into the DNA. First up, VU, Vanguard's S&P 500 ETF. It holds the 500 largest U.S. companies, from household names to economic powerhouses. Think of VU as the Tom Hanks of ETFs, respected, reliable, and always shows up when it counts. Over the long haul, it's averaged about 10% total return per year, with a dividend yield around 1.5%. Nothing flashy, just rock-solid performance. Next, we level up with VTI, Vanguard's total stock market ETF. This one goes beyond the S&P 500 and includes over 3,500 stocks, large cap, mid cap, even small cap companies you've probably never heard of, some with serious long-term potential. It tracks close to VU in returns, again, roughly 10% annually, but gives you more exposure to the up-and-comers. Dividend yield usually lands between 1 and 2%. And then we've got the wild card, SPDW. This one takes you abroad, with exposure to developed international markets like Europe, Japan, and Australia. While U.S. stocks have led the pack in recent years, global diversification can be your portfolio safety net. Different regions move on different cycles, and when the U.S. slows down, others might keep moving. SPDW has lagged VU and VTI in total return, but it offers a 2.5% dividend yield, and most importantly, global balance. So whether you want America's finest, the total market buffet, or a taste of the world, these broad market ETFs bring something powerful to the table. They've got ultra-low fees of 0.03%, long-term performance, and built-in diversification. But if passive income is your thing, you definitely don't want to miss what's coming next. Dividend ETFs. If you're the kind of investor who wants to see cold hard cash rolling in, even while lying on a beach with a coconut in hand, then dividend ETFs are where the party starts. These aren't just about growth, they're about income. Regular payouts, quarter after quarter, rain or shine. And for a long-term lazy strategy, getting paid just to hold? That feels like cheating the system. First up, DGRO. This one's the straight-A student of dividend ETFs. It focuses on companies that not only pay dividends, but consistently grow them. We're talking strong fundamentals, healthy cash flows, and a history of rewarding shareholders. DGRO hits the sweet spot, yielding around 2.5% to 3%, while delivering 8% total returns over the long haul. Expense ratio? Just 0.08%. That's $8 per $10,000 invested. It may not win every year, but it's built for the long game. Next, SCHD, the rock star of dividend ETFs. Blue collar, dependable, always shows up. It targets high-quality U.S. companies with steady growing dividends. Think Pepsi, Verizon, Home Depot. The yield usually lands around 3.5% to 4%, and total returns hover around 8%. It lags behind the growth-heavy VTI types, but here's why. These companies pay you now instead of reinvesting everything. It's income now, growth later. SCHD's fee is even lower, just 0.06%. Finally, VYMI, your dividend ETF with a passport. This one brings in high-yield stocks from around the world. European banks, Asian telecoms, Australian miners. If you believe the US won't always be the only engine driving returns, this ETF brings in some global flavor. The yield? Around 4%, sometimes more. Growth? A bit slower than SCHD or DGRO, and the fees higher too, 0.17%. But that's the cost of international exposure. So whether you want domestic strength, dividend growth, or global income, these ETFs deliver passive cash flow without breaking a sweat. But if you're after speed and don't mind a little turbulence, our next category kicks things into high gear. Growth ETFs. Let's kick it off with the headliner, QQQ. This ETF tracks the NASDAQ 100, home to the world's biggest tech and innovation giants, Apple, Microsoft, Nvidia, the all-stars rewriting stock charts year after year. Over the past 5 years, QQQ has delivered nearly 20% annual total returns. Yep, you heard that right. But that kind of growth comes with some turbulence. It's a wild ride, big ups, sharp downs, and you'll need a strong stomach to stay buckled in. The trade-offs? A low dividend yield under 1% and a higher expense ratio of 0.20%. But for what you're getting, it's still a powerful growth engine. Next up, SCHG. Think of it as QQQ's younger sibling, same tech-heavy DNA, but with a slightly different twist. You'll find names like Tesla, Meta, and other disruptors in the mix. Recently, it's kept pace with QQQ in returns, close to 20% annually, but comes with the same roller coaster volatility and minimal income. The silver lining? SCHG's expense ratio is just 0.04%, so more of your gains stay in your pocket. And finally, for the globally minded investor, there's IDEV. This one brings in growth stocks from international developed markets, Europe, Japan, Australia, and more. While it hasn't hit the same highs as QQQ or SCHG, it still posted a solid 12% return over the past 5 years. Like the others, the yield sits around 1%, and volatility is still in the mix. But at 0.04% in fees, it's an efficient way to diversify your growth bets across borders. So now we've seen the best-in-class, broad market, dividend, and growth ETFs. But only one can be crowned the ultimate forever ETF. Let's find out which one truly deserves a spot in your portfolio for life. All right, this is it, the moment you've been waiting for. After stacking up the contenders, one ETF rises above the rest. The ultimate buy and hold forever pick is VOO, Vanguard's S&P 500 ETF. Why VOO? Because it checks every single box. Diversification across 500 of America's biggest, most established companies. A battle-tested track record, thriving through every crisis, from the dot-com bust to the pandemic. Ultra-low fees at just 0.03%. a reliable 1.41% dividend yield, with dividend growth averaging 8.73% per year. And performance? Over the last 5 years, VU's returned a scorching 15.8% per year. But let's stay conservative and use the long-term S&P average, 10% annual growth. So what does that actually look like for you? If you invest $100,000 and reinvest the dividends, after 5 years, you'd have about $172,000, earning $2,500 a year in dividends. After 10 years, over $300,000, generating nearly $5,000 a year. After 30 years, you'd be sitting on $3.2 million with passive income of nearly $97,000 a year. That's more than $8,000 a month without lifting a finger. One ETF, steady growth, real income, and zero overthinking. That's the power of the ultimate lazy investing strategy. It really is that easy. If you want to build serious wealth without stock-picking stress or market guesswork, VU is the one ETF to rule them all. Simple, powerful, built to last. Just set it, forget it, and let time do the heavy lifting. Still hungry for more ETF strategies? Tap the video on your screen and let's take this to the next level, whether it's income, growth, or building your $1 million portfolio.